Welcome to the Cardinal Commentary for the Canadian Equity Portfolios. September is typically the weakest month of the year for the stock markets, and 2023 stayed true to form amid continuing high interest rates and stubborn inflation. The recent terrorist attacks in the Middle East are a wild card that could push oil prices and inflation higher in the short run. There is good news despite the weak stock market performance in the quarter. The dividend yield in our Canadian equity portfolio is hitting new highs and is well above the historic average. Dividends might not seem like much when they increase by a loonie or two per share, but they can really add up over time. Over the last 30 years, our Canadian equity portfolio has outpaced the market significantly. Portfolio manager Sheila Wilson-Cole says higher interest rates have had an impact on dividend-paying stocks as some investors have shifted to bonds. But she cautions against turning off the dividend tap.
When we take a look at our portfolios, for example, the Canadian equity portfolios, some of those stocks have been impacted, but when you look at the earnings since 2019, they're up about 25%. Dividends have grown around 25% plus. And yet the share prices are only up 2%. So there's a lot of really good fundamental reasons why these stocks should move up in value. Right now we're just seeing more of a short-term dislocation in the markets.
Statistics Canada recently reported some good news too. Inflation dropped to 3.8% in September, lower than analysts were expecting, down from 4% in August. That's thanks in part to falling prices for gasoline and certain grocery items. Regardless of what's going on in the rest of the economy, Intact Financial goes about its business as the leading property and casualty insurance provider in Canada. Equity analyst David Amy says the Toronto-based giant is the epitome of a Cardinal holding.
Its market share is 2 times the size of that of its nearest competitor, and this provides scale advantages that the company has used to drive industry-leading margins and growth over the long run. So Intact is able to have or gather more data than its peers. This allows it to better assess risks and price for those risks. It also provides them with a cost advantage, having the scale, being able to spread costs over a bigger base. So this has driven those best in-class margins.
And there's no questioning its commitment to dividends, which have risen at a compounded annual growth rate of nearly 10% for more than a decade. Just one of our companies, Fortis, increased its dividend in the quarter, marking its 50th consecutive year of dividend increases. But nearly 20 of our companies have done so this year. 2023 has been a challenging year in the markets, but our Canadian portfolios continue to perform when it really matters, like over 25 years. And here's the proof. If you had invested $500,000 in the Cardinal Canadian equity portfolios in 1993, it would be worth more than $9 million today, nearly doubling the benchmark. And why do we do all this? Because it works. And that's the Cardinal Commentary for the Canadian equity portfolio. Thanks for joining us.